Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone. This is March 9th, 2026. This is your host, Brent Foster of the Northbound Wealth Podcast, weekly market insights. Markets weather new Middle East conflict. So let's review last week and we'll go through what's happening in the markets and the economy and stuff out there. Stocks fell last week as investors assessed the implications of a fresh Middle East conflict while digesting mixed reports on the jobs market. The S&P 500 index fell 2.02%. The S&P 500 ended Friday's session at 6,740.02, while the NASDAQ Composite Index slid 1.24%, ending Friday's session at 22,387.68. The Dow Jones Industrial Average declined 3.05%, ending Friday's session at 47,501.55. The MSCI EAFE Index, which tracks developed overseas stocks markets, lost 6.62%. The Middle East conflict. So U.S. stocks were in the red for much of the week as investors digested the start of the U.S.-Israel war with Iran. The war, now in its seventh day, actually at the end of last week, it's a little further in now, has led to a wider conflict in the Middle East. Crude prices jumped above $90 a barrel as the Strait of Hormuz, the world's most important choke point for crude flows, remained effectively shut. Not because they couldn't move through there, but because of insurance on these container ships and security. However, the decline was short-lived as investors bought the dip. The three major averages recovered or nearly recovered from their intraday lows by Monday's close. We'll be watching for the de-escalation in the Middle East conflict as well as stimulus levers being pulled in the coming weeks and months to gain price stability in oil. As our base case, we also believe that the current oil shock will not lead to recession in the United States. Stocks open lower again on Tuesday as the markets mulled over the possibility of a protracted conflict. However, afternoon comments from the White House promising to provide risk insurance and U.S. Navy escorts to oil tankers and other maritime trade vessels in the Persian Gulf seemed to calm investors' nerves, enough for stocks to partially recover before the close. Stocks opened higher on the opening bell on Wednesday, driven by a tech rebound and stabilized oil prices. News of stronger than expected private employer hiring and ADP boosted sentiment. By the closing bell, the S&P 500 and the NASDAQ were in the green for the week to date numbers, okay? But markets were under pressure the rest of the week on concerns over a widening conflict. Friday, the losses in U.S. stocks deepened as data showed U.S. employment unexpectedly declined in February, and the job loss rate ticked higher. Non-farm payrolls fell by 92,000 last month, representing the biggest drop since October and a significant miss versus the consensus estimate for a 55,000 jobs increase. The unemployment rate rose to 4.4%, while Wall Street expected an unchanged print at 4.3%. Meanwhile, news that some oil fields in the Middle East had begun to cut production amid dwindling storage capacity added new complexity to the ongoing conflict. The weekly drop was broad, affecting every sector except energy. The materials sector had the largest percentage loss, sliding 7.2%, followed by a 4.9% decline in consumer staples, a 4.6% drop in healthcare, and a 4.1% slip in industrials. Real estate, utilities, and communication services shed more than 2% each, while financials, consumer discretionary, and technology also edged lower. PPG Industries and Freeport-McMoRan had the largest weekly percentage losses in the materials sector, falling 13% each. Also weighing on materials, Vulcan Materials shares slid 11%. JP Morgan downgraded its investment rating on the stock to neutral from overweight and cut its price target on the shares to $320 each from $335. In consumer staples, Brown-Forman was among the hardest hit stocks, falling 12%. The wine and spirits maker reported higher than expected fiscal third quarter results, but reiterated its full year outlook for organic sales to decline. The company is facing headwinds from structural declines in alcohol consumption, an oversupply of American whiskey, rising competition, and increasing costs, Morgan Stanley said in a note to clients. Energy was the lone sector in the positive territory for the week, rose 1% amid surging crude prices. Marathon Petroleum, Valero had the biggest weekly percentage gains, rising 11.6% and 9.8% respectively. So let's take a look at wide charts. NASDAQ Composite year-to-date trailings down 2.04%. S&P 500 is flat to slightly negative 0.01%, finishing last week. MSCI EFA index is only up 3.37% and falling actually more this week on Monday. Dow Jones Industrial average 0.08% to the positive year-to-date trailing number. And we've got 10-year Treasury note is at 4.15%, which is down 1.66% in the last month, down from the 4.22% print a month ago. Thank you, Y Charts, for that information. All right, again, focus on oil. As of Monday, March 3rd, 2026, U.S. crude prices rose to around $116.77 per barrel. That's an intraday high. When I last checked, it was around 95, so it's really moving up and down a lot. In particular, I think the futures contract for later on this summer in June and July is around $84. So they are expecting prices to decline by the summer, but it's going to take a little bit of time for that to happen based on futures pricing today. And by the way, that spike from last week to this week was the biggest weekly gain in crude since 1983. The conflict has brought tanker traffic in the Strait of Hormuz, a key shipping route for energy supplies, to a near standstill. Also, an ongoing concern is how insurance companies will adjust rates in the coming weeks due to heightened risks like getting blown up or blocking the strait altogether. That would be really not good. So, and those tanker ships move actually quite slow. They don't speed around the Strait of Hormuz. They move very, very slowly. So they're easy targets. All right. I posted out on the blog charts of the week, and they're from the Guide to the Markets. And I thought it would be relevant given the conflict that's going on to highlight a few things. So markets around geopolitical events, notice the duration to recover is quite quick, historically speaking. So what I have out here is a chart that JP Morgan Asset Management put out in equities. It's the S&P 500 sell-offs around geopolitical events, and it has going back to 1973, the Israel-Arab War, oil embargo. The duration of the sell-off in trading days was 27, and the size of the sell-off was down 17.3%. The duration to recover the prior level to that trading effect was in trading days 1,546. That is by far an outlier, and the world wasn't ready for that. So let's move on. The Shah of Iran exiled in 1979. 8 days, there was a sell-off of only 4.6%, and it took 33 trading days to recover that. Iranian hostage crisis was October 8th, 1979. Duration of the sell-off was 23 days. The size of the sell-off was 10.2%, 49 days to recover. Soviet invasion of Afghanistan, that was December of 1979. That was 11 trading days, down 3.8% was the S&P, and it took only 5 days to recover that. Libya bombing, we jumped to April 22nd, 1986. That was 19 trading days, a sell-off of 4.9%, and a duration to recover was 6 trading days. First Gulf War, August 2nd, 1990, 50 trading days of a sell-off, down 16.9%. Duration to recover was 81 days. Kosovo bombing, 1999, March 19th. 3 trading days, down 4.1%, but it took 8 days to recover. That's it. 9/11 attacks in in September 10th, September 11th, 2001, took 5 trading days. 11.6% sell-off, 14 trading days to recover that level. The Iraq War, March 24, 2003, 6 trading days, 5.3% correction. It took 15 trading days to recover that. Arab Spring in Egypt, January 28th, 2011, 1 trading day, 1.8%, took 2 days to make that up. Ukraine conflict, back in 2014, believe it or not, there was 5 trading days, down 2%, took 12 days to recover that. Intervention in Syria, September 19, 2014, 19 trading days, 7.4% decline in the S&P, and 12 days to recover. Russia-Ukrainian war, 2022, 18 trading days, down 9.1%, but 15 trading days to recover. So a couple of weeks after that. Israel-Hamas war would be October 12, 2023, 12 trading days, down 5.9%. Took 7 trading days to recover that level. And then the current conflict, Israel-Iran / U.S. war. I would say June 13, 2025 is when the conflict was beginning. 5 trading days, 1.3% to the decline, 5 trading days to recover. So the median data from what they've provided, 1973 to 2025, the duration of the sell-off in trading days is 11. Okay, and 5.3% was the size of the sell-off in the S&P 500 so far, and well, that's the median. 5.3% is the median, and the duration to recover is about 12 trading days. So it is potentially a short-lived situation. That's why the S&P 500 is really holding up right now, despite all the conflicts that are going on and the issues going on. And the source of the data is Standard & Poor's, Deutsche Bank, FactSet, JP Morgan Asset Management. Okay, and it's in the guide to the markets. It's slide 8. Oil markets, next slide. U.S. is a net exporter. So when it comes to U.S. net oil imports, we don't import nearly as much as we used to. We export and are a net exporter, and you'll be able to check that out on the charts. I won't go through all of it, but I think it's a relevant chart to put up because it just says we don't have as much foreign reliance on oil as we used to. So that's diversified and not just completely focused on. Unlike Europe, Europe is very reliant on their neighbors in the region to supply energy to them. All right, asset class returns, U.S. market, 2011 to 2025. Diversification among different asset classes is important in portfolio construction. Absolutely, can't emphasize that enough. If you're over concentrated on years where it's not going well in that particular space, you're gonna kind of be left suffering a little bit. You could do a better job by diversifying your portfolio and having some money in other areas. It smooths out the ride as well. So I really love this chart 56 in the guide. And it talks about all the different asset classes in the United States. It's principled investing. So I really like that. Where we're talking about from cash all the way to emerging market equity. So from conservative to super aggressive. Some of the other asset classes in here are commodities, REITs, domestic equity, small caps, asset allocation models like a 60-40 portfolio is overlaid in here. So you get to see what a 60-40 portfolio looks like. Anyway, you got fixed income in here, high yield, large caps, and again, cash. So you kind of get to see how portfolio 60-40 behaves, as well as how asset classes have done. And it's got the 2011 all the way to 2025. And this data is through the end of February, so doesn't include March yet. All right. What we've got for key economic data we're checking out Tuesday, the NFIB Small Business Optimism Index, is existing home sales. Wednesday, Consumer Price Index, federal budget. Thursday, weekly jobless claims, trade deficit, housing starts, building permits. Friday, gross domestic product. Q4, the first revision, so they revised those numbers, so we're going to be checking that out. Personal consumption expenditures index for January, durable goods January, job openings January, and consumer sentiment. And then this week, notable companies reporting earnings. Tomorrow or Tuesday, we got Oracle, Thursday, Adobe, and Wheaton Precious Metals. So we're going to be checking all that out as we go. Those are the notable ones. All right, tax tip of the week, 3 facts about capital gains. When you sell a capital asset like an investment or a piece of property, the sale can result in capital gain or loss. The Internal Revenue Code defines capital asset as, quote, almost anything you own for personal use or your own as an investment, end quote. Here are 3 facts you should keep in mind. Number 1, a capital gain or loss is the difference between what you originally paid for the asset, which is your basis, and the amount you get when you sell the asset. Number 2, the IRS may allow you to deduct capital losses on selling an investment or property. And number 3, if your total net capital loss is more than the limit you can deduct, you may be able to carry it over to the next year's tax return. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. We've got a good show for you. Stay tuned for the next segment. As tax season approaches, a little early organization may help things feel a little more manageable. This time of year often brings a steady flow of paperwork, deadlines, and decisions. So this message is simply a supportive reminder to help you gather what you may need. A good first step is collecting the documents relative to your return. Many people track down items such as W-2s, 1099s, donation receipts, and statements related to investment activity. So if you're a client of mine, you're custody likely at Schwab, and a lot of those have been rolled out to the middle of the late part of February. And here we are, the 9th day of March. So the deadline on April 15th is quickly approaching. The IRS provides comprehensive lists of forms and instructions on its website for direct reference. So irs.gov if you're wanting to search out those things. If you're missing older records or need to look back at previous filings, the IRS also provides transcripts you can view online or request by mail. These transcripts may help you confirm prior year AGI or adjusted gross income, payment history, or other details needed during filing. It may also be a good moment to review contributions you made to certain accounts, charitable giving records, or any other financial choices that relate to your broader tax picture. If you have questions about documentation from our office, such as statements related to your investment accounts, please don't hesitate to reach out. I'm always happy to assist you in accessing the materials we have on file for you, or Schwab or other custodians have on file for you. As tax rules shift from year to year, you may also want to consult a qualified tax professional for guidance tailored to your situation. My role is to support you with general reminders, your investment-related documents, and to keep you aware of any changes that may impact your long-term financial strategy. When you're ready to begin gathering everything for the season, again, irs.gov is a good place to go. And good luck during this tax season. Stay tuned for the next segment. Hello, everybody. This is your update on the Mortgage News Daily app. Go out to the app, download it. It's free. It's awesome. You get all the updates. And the 30-year fixed is trading 6.17%. The 15-year is at 5.77%. This is intraday. You got the 30-year FHA at 5.76, the 30-year jumbo at 6.48, 7.6 SOFR ARM 5.46, 30-year VA 5.77. We're kind of in the middle range. We're not positive or negative, like moving up or down. We're kind of just flat. And these volatile cross currents keep mortgage rates relatively flat, even with the oil spike. So from Friday to today. So go out to that app, check it out. It's a good one to have if you're looking for what mortgage rates are, and maybe potentially they're trying to purchase a home or refinance a home. Anyway, go out to Mortgage News Daily. You can go on the website or download the app. I think it's pretty cool, and it's a way to kind of stay up on what's going on and what the trends are. They have articles written by Matthew Graham as well, who has some insights on the mortgage market.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.